according to Clarkson, today the 1-year time charter for an Echo M are $33,500 per day, and for an LR1, $41,000 per day. And this gives you an idea where the market is at this exact moment. As you can see from the graph, we still have room on asset values for some increase. If we move on to the Ukrainian situation, of course, as you know, we have 2 dates, one in December and one in February, when Europe banned basically all Russian cargoes, before crude and later on products. This is both clearly EU imports slipped to very low levels, and the Russian oil exports slipped to 16% in January 2023, compared to 50% in February 2022. And Russia has been looking for buyers somewhere else, and they found them in Turkey, in China, and in India, as historically now is happening. As far as Russia refined product export, the loadings for European ports decreased by 73% between January 21 and February 23. Turkey increased by 191%, and Africa in general increased by 664%. I mean, countries in North Africa that usually, historically, were not importing Russian diesel, today they are importing heavily, due, of course, to discounted price. As you know, OPEC announced a larger and not expected cut of 2 million barrels per day. But as you, being part of the OPEC countries not in position to produce the full amount, the real cut is around 1 million barrels. The forecast for the supply on a worldwide basis, we are talking about 101, so we are overtaking the 100 million barrels per day in all the world. Going ahead, COVID is a story of the past, and we hope is not anymore an element of impact. Also, China now, as you know, is opening up, and we already start seeing the result of it. The oil demand is growing, and of course the refining throughputs is following up. So here again we have refineries which are pushing more and more their capacity. The levels of product inventories are very low, and which means that this is the basis for increased movement in the short future. We have a very tight market, a diesel market, in the US and in Europe. US is not common, because normally US is an exporter of diesel. But in this case, they are even importing on the East Coast. And the jet fuel demand, with the world going back to travel for holidays and for business, but mostly for holidays, the jet fuel demand is rising strongly. There are more and more flights operated by the airlines, and of course the jet fuel is rising steeply. Also, the crude tanker market is recovering in a very strong way, so we shouldn't see any more the competition of crude oil tankers in the clean market, as we saw in the past, because crude is paying very good rates. The long-term demand is always healthy and with a good growth, and the total oil seaborne trade from refined products is still 1/3 of the total, so is very strong. We have the usual changes in the refinery landscape. This is a slide you know very well. The growth of the refining capacity is mostly concentrated in Middle East and Far East, which means very much far away from the market, the consuming markets. U.S. shale oil is increasing very slowly because resources are not used to increase production, but are mostly used to pay back debt and to pay shareholders.